In this video, we're going to look at Spotify, and Spotify is a Swedish music streaming service. And what I do in my videos is I run my discounted cash flow model to figure out the true value of a company's stock. And then I look at the financial ratios of the company and compare them to its competitors. And I do this with you throughout the entire video, so it's like we're doing it together. And I'm going to be looking at the Spotify that's traded on the Frankfurt, Germany Stock Exchange because they report in euros. Let's get started with the model. This company has a market cap of 40.6 billion euros. And we'll put that into the model. And let's see what they're trading at. They're trading at 228.10. So that's one share of stock. And then let's get their free cash flows. And the way you value a company is you estimate the future free cash flows, then discount that number back to today's value, which is what I'm doing in this video. And free cash flows is cash flows after operating your business minus capital expenditures. Now I'm going to pull the net income, which is the profit and loss on the income statement. And every year they have a negative net income. And then I'm going to pull the revenue, which are the sales for each year. And the revenue has been growing really nicely every year, so that's a good sign. They just need to get their profits in line. Let's look at the capital structure of the company. They don't have any debt, so let's get the beta so we can figure out the cost of equity. The beta is how volatile a stock is relative to the market. And they have a beta of 1.65. So the stock is a bit more volatile than the market. When a stock is volatile, it tends to be more risky. Let's also go back to the balance sheet and get their current assets. We need this to calculate the current ratio later, and that's $2.2 billion. We also need the current liabilities to calculate the current ratio, and that's $2.4 billion. And the equity on the balance sheet is assets minus liabilities, and that's $2 billion. Let's get their EBIT, earnings before interest and taxes. We'll go back to the income statement, and that's negative. They're operating at a loss. Let's look at the capital structure. They have no debt, they're 100% equity, and the cost of equity is 15%. The way we figure that out is using the capital asset pricing model. And that's a discount rate we're going to apply to the future cash flows. So we estimated 4 years of future free cash flows. We also did a terminal value, which is all years past year 4. That's $23 billion. We discounted those numbers back to today's value, and we get a value for the entire company of $19 billion. We divide that by 178 million shares, and we get an intrinsic stock price of 108. It's trading at 228, so it's trading at a 111% premium. So it's a sell according to the model. Let's see what Simply Wall Street values the company at. They're at 187 a share, so they're a little higher. So I used a really conservative model and assumed more of a growth rate than their financials indicate. And they're still well below what they're trading at. This is one of those situations where the market just sees the future of this company as being so strong that they're willing to pay a big premium for the stock. Let's see where the stock has been trading the past few years. So it looks like it was trading closer to intrinsic value for a while, but then it's been driven up the price. It seems like during coronavirus it was pushed up to a high level. So it's really difficult to invest in companies like this. And let's see if we can look at their financial ratios to get more information. They have a negative price to earnings ratio because they have negative net income. Their price to sales ratio is 6.0, which isn't so great. That's price to stock 228 over sales per share 38. And to get sales per share, that's revenue over shares outstanding. When a company has a negative PE, you look to the price to sales ratio. Price to book is also pretty high at 20. That's price to stock over book value per share. To get book value per share, it's equity over shares outstanding. I like to see below 3.5 for this ratio. Current ratio is below 1. That's current assets over current liabilities. So they can cover their current liabilities. Negative ROE, because like earlier they have negative net income, so they have negative ROE. The best way to look at ratios is to compare them to similar companies. I did videos on Facebook, Google, Match, and Yelp. They're all in the same industry as Spotify. And Spotify is right here, and if they have a number in green, they're better than the average in the industry. If they're in red, they're worse than the average. They have negative PE, so you can't really look at their PE. They have a better price to sales ratio and a better price to book ratio than their competitors. They have a lower current ratio. They have negative ROE, so you can't really look at that. They have no debt, just like Facebook and Yelp. And they're much smaller than the average company. The average is $341 billion because companies like Google and Facebook really drag up the average. So it could be a really great stock to own in the future. It's just hard to invest in a company unless they provided some returns and some profits. Although people make a lot of money investing in these companies, people making tons of money in Tesla, and they haven't really turned too much of a profit, just more recently. So let me know what you think of the video. Thanks for watching.